Hello, welcome back. We're going to be taking a look at JD.com. The company actually posted earnings earlier today and it really crashed. It went down like 15% despite the results being not that bad really. And we will talk about it then. We will take a look at the financials of the company as well as work on a discounted cash flow model to tell us whether we should be buying the company and at what price. Now, first things first, if you are new here and you enjoy this kind of content, you may think about becoming a subscriber and also like this video, because if you do, that really helps with getting more eyes on it and helps the channel grow and helps me make more videos for you. So thanks for that. And as you can see here, and what I wanted to take from this article is the fact that JD's Q4 results were slightly worse in terms of year-over-year growth in revenue compared to Q1 and Q3, but still revenue of 43 billion, which met the consensus estimate pretty much. And the article goes in detail about the growth and the valuation of the company, but we're gonna be taking a closer look at our tool here, and we'll examine the financials and see whether it makes sense to buy the stock. Now you will see here that the company has been a high flyer for a long time, and it reached about 110 over here, and then went down like 50%. And you will see that the 1 year decrease of the stock has been sitting at almost 42% here. Now what has the company been doing in terms of shares here? So they have been issuing shares, again, following the trend of companies trying to take advantage of the stock price getting higher and higher. And so if that ever loads here, yeah. Okay, so they did they did issue a lot of shares back in 2015 really here, and also generally speaking steadily increased their outstanding shares count here. But in 2020 they kind of stopped, it looks like, which is a little bit weird because in 2020 the stock actually started to climb, so they haven't been issuing too many shares at that time. And this means that they more than likely won't be issuing shares now because the stock is like 50% of what it used to be, and doesn't make a lot of sense to do that. Okay, so let's take a look at the company in more detail now in terms of the financials of it. The market cap of the company is sitting at 81 billion, and let's take a look at the income statement first to see what kind of income the company is making. And this is adapted for US dollars, by the way. And you will see that the year-over-year growth of the company in terms of revenue has been sitting at about 25 to 30% pretty much every year, and even the last 12 months have been at 30%, which is pretty great. It's the best that they had since 2017 really. And the net income of the company is sitting at $4 billion, massively increased from previous years, but 2020 was actually better. The last 12 months have been a little bit of a stall here. Yet, if you compare it to 2017 or 2018, the company started posting pretty good growth here in terms of net income. Amazing, really. Again, when you compare it to negative net income in the previous years. The balance sheet of the company here, total assets sitting at 75 billion from 28. That's a steep increase, threefold increase here. Great for the company. And what about the liabilities? The total liabilities of the company are sitting at 36.2 billion, which is quite a lot as well, but still they have many assets to back that up with. Total equity of 38 billion, and look at that, they used to have 8 back in 2017. Now they have 38. That's absolutely insane. That's like 5 times as much almost. So awesome growth here. What about cash flow? The operational cash flow of the company is sitting at 6.3 billion. And yeah, it keeps increasing here. What about the cash from investing? Companies investing a little bit. Investing in market securities, which again is something that I like to see, as long as it's not the only thing that the company invests in, of course. And also some capital expenditures, not too many actually, and it seems like it's decreased since 2018. Okay. The cash from financing, it is positive, so the company is actually getting some debt, I'm assuming. Yeah, they do get some debt, and they are actually issuing shares, as we already saw. And they probably have to stop that for a while because it doesn't make too much sense, I believe, right now. The companies, especially now that the stock price is 52, it may not be the best idea to keep issuing shares. We'll see about that when we examine what's the actual intrinsic value of the company. The free cash flow from 3.1 billion, it actually fell down in 2018 and 2019 2020 went back strong, back up 4.8, and the last 12 months 4.6, pretty good here. What about the multiples of the company? Wow, these are very low multiples here in terms of sales. So the enterprise value compared to sales is 0.6, 0.4 here in the next 12 months. So that's amazing, because it means that we're looking at an undervalued company based on the sales that they are making here. What about the profitability? Sitting at 12%. This is rather typical for e-commerce companies like Amazon or Alibaba. You'll see a similar figure here. Probably about 8 to 11% is what you're seeing normally. So that's pretty good in comparison. The solvency here, 15% of total debt to equity. That's pretty awesome. And you will notice also that with the free cash flow that they're making like 4.6 right now, almost 5 billion is what they made here, and they had total liabilities of 36. So this is about 7 to 8 years of free cash flow. They may want to reduce that a little bit, although I'm not too worried about their debt situation at all, really. So their assets in comparison to their debt are way too many, and so the company's financial position looks great right now. Now, despite the company's financials looking great and the company growing, we do understand that this is a Chinese company and there are some risks, but it also means that we're potentially getting the company at a discount if we actually decide on actually purchasing the company. However, we want to examine what kind of price it makes sense to pay, because a discount is a very broad term. What kind of a discount? How much are we getting is what we want to see here. And the way to see that is by examining this stock evaluation tool that I have here on the application that I have developed for Investors Heaven. And you will see here that we're getting a breakdown of the revenue growth of the company, the net income growth, as well as some margins for net income and free cash flow. And this is very well summarized here so that we can use it for our projections. And as you can see, the company had a pretty much steady near 30% revenue growth. So I'm gonna go 20 for my low estimates, which is gonna be the conservative ones. 25 and 30 is what would probably make sense here. And still, I'm kind of conservative even here, if we take into account the previous years, of course, because companies will not be growing at 30% every year. That won't be happening. Although I think for the next 5 years, which is what this model is for, I think there is a probability actually that JD will be doing that. So net income, despite that, however, we need to be conservative in our estimates. So 20 is probably fair here, maybe even 25. Net income margin is rather low here, and margins for this kind of companies tend to be low. So I'm gonna go 1, 2, and let's go 4 here, be a little bit more aggressive. And the free cash flow margin, this is the odd one out, I'm assuming. That's been happening because of this amazing increase here in terms of the free cash flow margin. Is where the company actually started posting positive net income, as you can see, because previously it was negative, and so we're getting negative free cash flow margins, meaning that we were not getting free cash flow from profitability, but now we are. And so you saw the steep increase, which is not ordinary though, and we cannot use that. We're probably going to go with like something in between. This is why I'm having the 3-year average and the last year as well, so that you can use that, and also you see that full breakdown, so that you can actually identify which values you want to use. So I'm gonna go with something like 40, 50, and 60 for now, which I think is fair. It may be actually a little bit undervalued too. The annual return that I want to be getting from my investment is about 13% here, so I'm gonna discount for that, because I can get 10% from an S&P 500 ETF. So if I'm investing in a company, I want to be getting more. So calculate. Let's see what we're getting out of this. As you can see, our low estimates are sitting at $9. Our medium estimates are sitting at 27, and our high are sitting at 77.8 over here. So our low ones and medium ones are way off from the current price. And that has a lot to do with the net income margins of the company, as well as the free cash flow margins, because they are still a little bit unclear. Now, these may be a little bit too conservative, because we don't have many years of profitability for the company. As you can see, net income is positive here, here, and here. So there are years where the net income is not positive, and that cannot really give us a positive free cash flow margin. So if I'm going to consider a company that's growing at a relatively normal free cash flow margin, and even more conservative, I could even go 70, 80, or 90 here. And in that case, I would get a little bit of a better price for all my estimates here, but still it would be a red for the low and medium projections. And it would be a red because the current price is sitting at $52. That means that while I like the company, because of the fact that the company does carry some risk, being a Chinese company right now, if I'm deploying capital, I want to be getting a better alternative. I want to be deploying my capital in a better company. And again, if I'm employing capital on a Chinese company, there may be a better one, and this is in my case why I picked Alibaba, because the numbers were better there. Now that doesn't mean that this is a no-go forever, because if it drops a little bit more, I may actually even think about getting a little bit of it. I still think that it is a little bit of a stretch to buy it right here, but if it drops, near 40 or so, then it may start, it will actually reach the medium levels for this kind of projection here. And then I may actually be thinking about getting it. It would become a much, much better value in my view. So hopefully that gives you an idea of what I think about the company and what the actual evaluation thinks. And this is based off of metrics and mathematics. So that really helps us understand what's the potential of a company and what we should be buying it for today to be making some amount in the next few years. And that is 13% what I used here every year. And if that helped you a little bit, please like the video. That really helps a lot, as I mentioned. And you may want to subscribe, because I'm making tons of videos about all sorts of companies. And you can also ask me to make a video about a company that you want. Whatever that company is, I can actually take a look at it and come up with a video. So let me know. Thank you for being around, and thanks for watching this one. And in the meantime, take a look at this video that I made, and it's about Alibaba. And we're examining what the company is doing, why it crashed, and why I still think it's a fantastic buy right now. Thank you for watching this. See you soon. Bye.